The stock market is at all-time highs. The Magnificent Seven are lavish with extremely rich valuations. All the while, employment is weakening, and yet nothing has crashed. Here's the thing. The stocks that have been winning up to this point are about to stop working. What's going to happen to most investors? Well, unfortunately, it's looking like they'll be caught completely off guard. I've been investing since 1980, and I've compared current market conditions to every major rotation and cycle in the past 4.5 decades. This leads me to an important conclusion. I'm going to show you exactly what's been propping up this market, why 2026 will look completely different than 2025, and most importantly, how to position yourself before the next shift happens. If you like this kind of theme, be sure to hit the like button below so I can record more videos like this one. Now let's break it all down. So let's start with the obvious question. Why hasn't the market crashed when everything looks so damn expensive? Look at the valuations. When you look at the Magnificent Seven, Apple, Microsoft, Nvidia, and the like, you'll see that the average PE ratio stands around 30. That's pretty high premium for these shares. And mind you, when I say pretty high, I don't mean kind of high. I mean the highest ever, which is kind of the scary part. The S&P 500 itself has a PE of 22. The last time we saw those levels was back in the year 2000, right before the bubble imploded and many tech stocks fell 80 to 90%. Want to know the real scary part? While most of the Mag 7 is trading at a lofty PE around 30, Tesla is actually trading at a nosebleed level of 289. So let me ask you a simple question. Would you pay $50 for a $10 sandwich? Because that's essentially what investors are doing by piling into these same old mega cap tech stocks. Unfortunately, they're doing it on a much bigger scale with their entire nest egg. I've been investing for over 40 years, appreciating the lessons of history. And here's one thing I've learned. When valuations reach extreme levels, it doesn't mean the market crashes right away. What it does mean is that easy money has already been made, but what comes next will require more selective stock picking. There won't be as many easy wins going forward. You're going to have to roll up your sleeves a little bit to find the new breed of stocks ready to outperform. Stay with me a little while and I'll show you precisely how to find those next winners. But the problem is not just about valuations. The economy is showing some cracks. Job additions have fallen below 150,000 per month. On the surface, that doesn't sound like such a big deal. Unfortunately, 150,000 is the threshold to simply keep up with population growth. Anything below 150,000 a month, and employment will start to rise. And that is what is happening now. So why is employment so weak? It all stems from tariff uncertainty. Don't let anyone tell you different. It is a simple fact of life that when businesses don't know what government key policies will be, they press pause. They delay expansions, they cut unneeded spending, and they reduce hiring. So with all these warning signs flashing red, why are stocks still making new highs? Before we move on, if you like what we're doing here, go ahead and hit subscribe. It's the best way to know when I post new videos. So back to the key question, why hasn't the market crashed? It's simple, because mega cap stocks have been an unstoppable momentum machine for 5 straight years. Truly an easy button for investors. Think about it. What's worked in the market since 2020? The Magnificent Seven, AI stocks, big tech. It's been the easiest trade in modern history. Just buy the biggest names and watch them go up. You can't get any simpler than that. When stocks keep going up, more investors pile in. This pushes the stocks to go up even higher, which attracts even more investors. That's how momentum works. It's a self-reinforcing cycle. Think of it this way. It's like the Kansas City Chiefs won every game for 5 years straight. Eventually, everyone would bet on them, and the football spread would get ridiculous, like 20 points or 30 points, which eventually would make it impossible to win the bets. That's what's happening with mega cap stocks right now. Everyone's on the same side of the bet, and valuations are getting extreme. Want proof? Large and mega cap ETFs dominated by these overvalued stocks saw record inflows the past 2 years. Meanwhile, small cap funds saw massive outflows. The disparity in positioning and valuation is getting extreme. We finally saw a warning shot in November of 2025. Investors got nervous about valuations for a hot minute, and AI stocks sold off pretty heavily. But then what happened? They bounced right back. The momentum machine is back on full tilt, and valuations are pushing to even greater extremes. So why did investors so easily dodge this recent warning shot? Consider the time-honored investment quote, "Bull markets don't die of old age. They die when something breaks." Indeed, we are still in a bull market. In fact, 85 to 90% of our entire lifetime has been spent and will be spent in bull markets. Think about that for a second. Markets are designed to go up. It really takes a lot of things going wrong to create a recession and therefore a bear market. The current bull market started in October 2022. Well, that's only 38 months ago, while the average bull market lasts for 63 months on average. We're not even 2/3 of the way through the normal cycle yet. So what's keeping the this bull market alive? Well, time. Secondly, we have the old adage of don't fight the Fed. They are clearly on a rate-cutting spree that will continue into the future. This is a catalyst for the economy that kind of puts a floor under asset prices. Here's another thing to consider. If Powell leaves or is replaced, Trump wants rates as low as possible. So the next Fed chair will no doubt be even more accommodative to bolster the market. Second, corporate earnings look solid at an expected 8% year-over-year growth rate coming into the new year. And as long as earnings are growing, it's hard to be bearish. Third, the economy is still growing. Not gangbusters, but most indications point to 2% GDP growth ahead. Not great, but is clearly north of recessionary territory. So you've got rate cuts, earnings growth, and economic expansion. These are the three forces currently keeping the stock market aloft. However, from October 2022 to now, the market has gained 91%. The big gains from early in the new bull market are already done. They are in hand, and that's why 2026 will be so different. As we mentioned, for 5 years now, the winning strategy has been dead simple. Buy the Magnificent Seven and win. It's truly been an easy button. But easy buttons don't last forever, and this one's getting pretty worn out. So here's what's about to happen. The stocks that have been winning for the past 5 years are going to stop working. And when that happens, it will create a lot of confusion, which begets volatility, which begets new opportunities. Only those who are prepared will capitalize on this new trend. Let me show you something that Wall Street doesn't want you to focus on. Why don't they want you to focus on it? Well, it would certainly feed into that confusion that we were just talking about. This chart shows the valuation gap between large cap stocks and small cap stocks. Right now, small and mid cap stocks are trading about 40% below where they should be relative to their large cap peers. Here's the kicker. Over the past 100 years, small caps have greatly outperformed large caps by a wide margin. But for the last 5 years, it's been flipped. They're dramatically underperforming. This is one of the biggest mispricings I've seen in the market, and this is where the opportunity lies. Let me put that in perspective. For small caps to match the valuations that are large cap peers, they would have to rally by 40%. That is the expected gain for the average small cap. Our goal is to find the best small caps who will enjoy even better performance. I will show you precisely how to do that in just a few minutes. Now, why don't the more major firms focus on this? It isn't some kind of conspiracy or anything crazy like that. It's a simple matter of incentive. Wall Street makes money on liquidity and scale. Mega caps are easier to trade, easier to research, easy to sell to institutional clients. A $3 trillion company that everyone's heard of, and probably you use their products every single day, that's a pretty easy sell. In comparison to that, consider something like a $2 billion industrial company from Ohio. No offense, Ohio. That takes actual work from these firms to get the full lay of the land and to end up with some real actionable research. So, what does this mean for investing in 2026? Well, you should expect volatility. Mind you, I didn't say crash, just extra volatility. When I say that, I mean multiple pullbacks and corrections as we rotate from one group of stocks to another. That is what happens when 5 years of tech momentum starts to sputter. The November sell-off was a warning shot. Some investors are getting smarter, but human nature being what it is, will probably see a bit more euphoria before the hard lessons are truly learned. All right, let's recap. Mega caps are overvalued, small caps are undervalued, and volatility will increase as we rotate from one group to the other. So, what's the actual game plan here? This is not going to be another easy year of 20% returns for index investors. It's going to be a stock picker's market. Here's your winning framework for being a stock picker in 2026. Step 1, rotate out of overvalued mega caps. I'm not telling you to sell everything tomorrow, but if you're heavily weighted in stocks trading at PEs over 30, let alone 100 plus, then start trimming now. Just remember the phrase that pigs get fed and hogs get slaughtered. Be thankful for the gains already in hand before they evaporate. Step 2, rotate into small and mid-cap stocks with strong fundamentals. First, we're going to take advantage of the 40% valuation gap we already talked about. Then we're going to supersize that gain by focusing on the highest quality picks. I built a free stock screener on WallStreetZen that's already filtered for exactly what I'm talking about here. Small cap growth stocks with strong fundamentals. The link is in the description. You can browse through it, see the criteria, and definitely find a few tickers that fit the bill. Now, if you want more than just a screener, like hand-selected stocks with full analysis and a track record of outperformance, you should check out my Zen Investor portfolio. That's where I share my top 20 stocks to outperform the year ahead. The link for the Zen Investor is also in the description. Step 3, use the buy the dip strategy. 2026 is going to be volatile. There will be plenty of pullbacks and corrections, and every single one of them is a buying opportunity inside a bull market. When the overall market pulls back just say 5 or 10%, you often see even steeper drops for smaller risk-on stocks. So, as some people are panicking, that's exactly when you buy the quality small caps at even better prices. This is the best way to turn volatility into profit. When you're looking for stocks like these, the best place to start is our buy the dip stock screen. With the default settings on, it's turned to find healthy growth at fair prices, and it shows tickers that have seen at least a 5% share price drop in the past week. Of course, you can play around with it and tweak the settings. I highly suggest you check it out. The link is in the description. Step 4, focus on momentum. There's always a bull market somewhere. Sometimes it's in tech, sometimes in industrial, sometimes in healthcare. What you want to do is find where the momentum is actually flowing in the future, not playing catch up on an old trend that will soon end. However, the trouble is that, well, it could be a tall order for the ordinary retail investor to find out where the momentum is. The easiest way to do this is by looking at a stock's Zen ratings. Specifically, you want to hone in on its momentum score. This metric of ours takes into account 22 different measures of momentum, not just short-term, but long-term as well. This gets distilled down to an actionable rating between A and F. Just like your grades in school, you want as many A's and B's as possible while avoiding the rest. What should you not do? Don't panic sell during corrections. We're still in a bull market. Pullbacks are healthy and normal. And don't chase sky-high PE ratios just because AI will change everything. Just like the painful lessons from the dot-com bubble of 2000, we need to appreciate that high valuations equals high risk. Finally, let's bring this all together. We're still in a bull market because of the following reasons. The Fed is cutting rates. Earnings are still growing. The economy is still expanding with no recession in sight. What about the crash everyone's waiting for? It's probably not coming in 2026, at least not in the way people think. But here is what is coming. A rotation from one group of stocks to another. A change in what works and what leads to outperformance. Large caps have dominated for 5 years straight. Now the valuation gap between them and small cap has reached extreme levels. In 2000, everyone owned tech. The winners rotated to value early. That logic still holds true today. The market in 2026 will look very different from last year, not because of a crash, but because of rotation. The investors who will win will be the ones who rotate out of overvalued mega caps and into undervalued small caps before everyone else figures it out. To the people who see the valuation gap and position themselves accordingly, this is not about timing a crash. It's about recognizing when one group of stocks stops working and gets positioned into the next winners early. If this helped you see what most investors are missing, please hit like and subscribe below. If you enjoyed this market commentary, I highly recommend you watch my video that follows detailing Vanguard's projections for the market in 2026 and beyond. This includes my take on how to maximize gains in the near and long term.